And let's go to the headline story, which is Nigeria's GDP for the second quarter. In today, stronger 5.01% analyzed basis, quarter-on-quarter basis. The GDP figure shows a negative 0.79% in the April to June period against a growth of 0.5% in the first quarter of this year. There's a lot to unpack in the 99-page document, but let's get some perspectives into the manufacturing, banking, and financial services in this two-part conversation. My guest tonight is Bunmi Bajomo. She's the group head in charge of banking and corporate banking and manufacturing at First Bank of Nigeria. She's here to take me first through the big numbers first and break it down. Good evening, madam. Good to have you.
Good evening, Bosin. Thanks for having me.
Thanks for coming. A very big day whenever GDP drops. It's almost like a bombshell. But simplify the numbers for me. Give me an overview of this latest GDP report. Some of the percentages could be a little bit confusing to the man on the street. Let's start with the headline figure, by the way.
Thank you very much. And thanks for having me once again. Yes, the GDP numbers are out. And you've rightly pointed out on the screen, we grew. And we grew significantly. That is fantastic. But is this growth backed by development, or is this growth that has left behind development? I will say the devil is in the details. If you look at the broad overview, in terms of nominal numbers, which is actually the total value of goods and services that we have produced as a nation, I will say we moved from 39.1 trillion and we moved to 40 trillion. Right? And then in the real sense of it, when you factor in the impact of inflation, would we say this is a growth? In nominal terms, if you look at quarter one versus quarter two, no, it is not a growth. It is actually a decline of about negative 2.23. But if you are looking at year on year, yes, we have grown by 5.01. Which is significant because if you look at what we've all postulated, we knew this would happen going by the base effect of where we were last year during the lockdown with COVID impact. The growth for quarter two of last year was actually a deficit of over 6%. So if you mirror that to where we are now, increased tempo of economic activity, some measurable activity in transport sector, airlines, and in the production segment of the economy. Yes, you see the growth, but we would have thought, okay, something in the region of 3. So achieving 5 is a milestone. But if I look at what we did in quarter one of 2021 versus where we are now, it seems like there is a slowed momentum in terms of what we are actually producing as a nation. And then I think I can explain why that has happened as we go along.
Yes, you touched on the some of the real numbers in terms of the Naira and Kobo terms, because when we talk about GDP, what a number of folks on the street wants to know is about, well, what does it really come to in Naira terms? So percentages, what does it really reveal about Nigeria's growth in the first 6 months of this year? Can you put that together again for me in terms of the first 6 months of this year now? If we add quarter one to quarter two that we currently have, how have we fared? 6 months.
Okay, I would say we fared well. So half year to date, quarter two, we actually grew positively by about 2.7%. Mm-hmm. If you mirror that to where we were, quarter one and quarter two of 2020, which was a negative of 2.18. Yes, we have grown, and the growth is significant. And then another positive would be, if you look at, we have a total of 19 sectorial headings as a nation, Nigeria.
That means the GDP, yes.
Yes, but if you look at it, in terms of how many of those sectors have grown for quarter two, whether they grew by 1% or less than anything, as long as it wasn't 0, 16 of 19 grew. That is fantastic. But if you look at it, would a growth of 0.1% take us to the promised land or where we intend to go in? No. So I've categorized the sector in terms of the superstars who have grown above the level of population growth.
We'll come to those sectors in a while. So okay. First 6 months we did about 2.7%.
Yes.
Some of the forecasts that we've seen this year, even by government officials, that you will do about 4 or so percent. So technically, we're halfway down there. Now, in terms of the non-oil sector and the oil sector, give me a little bit of that.
Okay. Thank you very much. So in terms of the non-oil sector, we've seen significant rebound in the performance of non-oil sector, whereas we've seen the oil sector contracting. I would wonder why we are contracting so much in the oil sector, given where we are in terms of oil prices and our production. So between Q2 of 2020 and Q2 of 2021, as of Q2 of 2020, our total production as a nation was 1.8 million barrels per day.
Yes.
Today we're at 1.61. In quarter one, we were at 1.71. So give or take, plus or minus 200,000 barrels per day. But look at the oil sector. In Q1, the contraction was a marginal 2.2%, roughly. But in this quarter, we've contracted by over 12%. If you place that quarter on quarter, we've actually contracted by 20%.
So technically, the oil sector is in the water.
It's in the waters. And, it dovetails into everything we are saying. So good enough, the non-oil sector has stepped up the plate, is grown. So whereas the oil sector is now contributing about 7%.
So here we go with the non-oil sector. When we say non-oil sector, who is in that basket?
Everything but oil and gas.
Including broadcasting, which we're doing.
Yes,
and
please.
Banking.
Absolutely. So you have the agri sector, you have manufacturing, you have cement, you have construction, you have over 18 other sectors outside of mining and quarry where oil and gas resides. So all of the other sectors have stepped up to the plate, whereas you've seen a contraction in oil and gas. All of the other sectors actually grew, constituting the 16th sector that I actually mentioned, and then contributing well over 92%.
Interesting that a number of sectors that were down massively, like road transportation, rail transportation, make some major comeback.
Yes, please. But you see, is it unexpected? No. Last year, we were all locked up. We were in our houses. Nobody was moving. The only thing we had was bossing and bossing's colleague and our TVs, right?
Yeah,
and our gymming equipment.
We were just managing, and you should say thank you. Because each time you tune in your TV, by the way, you get to watch television. But for those of you in the banking sector, we also say thank you because the ATMs never stop running off cash.
Yes, we were all
So I appreciate that.
Thank you. We were actually at work.
So we were at work.
Yes, and banking sector actually grew by over 28%.
But I remember that there were a lot of restrictions about state-to-state, interstate movement. Government says you can't drive from one state to the other last year. I think that was a whole lot of hard hitting for the transport sector.
Absolutely.
But here they're back in full business.
Yeah, absolutely. So you see the transportation sector contracting by over 25% as of last year, but this time they've rebounded by above 75%. That is significant, and it mirrors what happened in road transportation, the rail transportation with the launch of the new rail lines. It mirrors what happened in shipping. Port activities have increased, and you see a lot of congestion at the port. That's why you've seen significant uptick in transport and storage. Everybody is trying to store one thing or the other in anticipation of a revamp in the level of economic activity. So you've seen significant growth.
Yeah, well, we'll talk about something very important, some sectors where we come back. Agriculture, for example, I want to know if we're producing more food. In manufacturing, which is part of your portfolio at First Bank, and as well the banking and financial services sector. How have you folks fared now that everyone is back in business? Perhaps more money is going out of the left pocket into the right pocket. Stick around, everyone. Let's talk about this when do a deep dive of the GDP report when we return. Stand by, Dr. Bajomo. Stand by, everyone. We'll be right back. Welcome back to the GDP conversation. Raising the curtain with comments and analysis trailing the latest Nigeria's report is Dr. Bunmi Bajomo of First Bank of Nigeria. Thank you so much, Doctor. Let's kick off where we stopped about sectoral performance, and I was asking whether food or crop production has got a whole lot better. We'll talk about manufacturing and industries, but let's put some food on the table, by the way, first.
Thank you. So in terms of the agri sector, as you know, constitutes over 22% of our national GDP. So whatever happens in that sector affects us all. But if you see what has happened in Q2, the agri sector grew by 1.3%, coming from a better performance of above 2% in Q1. What is affecting the agri sector? I would say it's a combination of factors, which you will see across all the other sectors in terms of the current exchange rate regime, in terms of the level of security, the ability of the farmers to produce, and the ability of the farmers to actually sell what they produce, our storage capacity and amount of wastages that are occurring in the process of trying to beat security to get goods to where they would be better priced. In terms of the sector within agri sector, each of the sector actually recorded positive growth, but at a declining rate. And that is a cause for worry. But the good news is that, you see a lot of intervention of the CBN in this sector. You see so many rice pyramid coming on. But the major thing that will change the performance of the sector is the time we stop focusing on primary commodities. As you see us as a nation right now, we are almost like price taker at each of the production spectrum.
Period, yes.
We produce primary cocoa, sesame seed. How many refining capacity or processing capacity do we have? Only a few. So, and then when we export this item, we export to countries and we're at their mercy. Do they take it, and at what price?
So the agri sector, sorry to call you respectfully, madam. So if we look at the agri GDP for second quarter, then perhaps it's understandable how we look at food inflation and inflation in recent months, isn't it?
Absolutely. So what fits into what is price is, number one, your cost of production. And then cost of production mirrors the cost of producing the primary commodity, the cost of processing where you process, and the cost of shipment, and ultimately how much of a bargaining power you have in the process of sale. Given what is happening right now in terms of ability to source equipment for the production of goods and services, it is not unexpected that you see the level of commodities prices going up internationally. We're a member of the international community. So price across commodity have gone up significantly.
Yes.
That dovetails into what we produce. And they're given our own market imperfection, security challenges. It affects ultimate landing cost of this item, and it affects the ability of people to buy. If you know what is happening in the economy, the disposable income has come down because people's income has been static. Tax levels have gone up in terms of withholding taxes and all the other tax parameters. So the ability of the consumer to purchase has reduced. So in terms of their purchasing power, it's ultimately reduced. Given the level of inflation, there will be some kind of purchase substitution from one product segment to the other, given the level of people's income. And then for the producers as well, they need to pass on this cost to consumer. They can't bear it. You can only bear it for so long. So they will pass it on, but does the ability to pass it on impede their ability to sell? That is debatable, but definitely it does.
Yes. The part of what your comments, Dr. Bajomo, about agricultural wastages, bags of tomato and all of that, and onions and whatever, it all goes therefore into manufacturing and industry. So let's chat a bit to that and look at the table for the manufacturing sector in the second quarter GDP. How is this particular critical, real part of the economy fared?
Okay, so I'll say in terms of numbers, the comparison, yes, they fare marginally better, because for Q1, the growth was about 3.4, in Q2, 3.49. Is that what we would expect if we're going to be a leading manufacturer in Africa? Let's not even talk in the rest of the world. No. And what are the things that are affected? So what you see in the manufacturing sector, it goes beyond analyzing numbers. It's a combination, it's a myriad of issues. It's a combination of what is happening in the global community and what is happening in Nigeria. In terms of global impact, you've seen significant increase in cost of shipment of goods and services across the world. Prior to COVID, the average cost of shipping equipment, products from China to North America or Europe was about 2,000. But you see this boom bust cycle since the advent of COVID, average cost of shipping material across the world right now is about $12,000. In developed countries, maybe they are able to wriggle this out. But for us as developing economy, when you mirror that impact of shipment to the fact that suppliers are pulling back on provision of spontaneous finance, given the slow cycle of our producers in settling their trade obligation, it begins to impact their cost of production, harder to port congestion, demurrage at the port, and also the landing cost of the item. They now add that to the taxes and levies and the overall cost of production.
And the cost of business, sorry to cut in there. So that brings us to one very important part of manufacturing industries, which is the fact that the banks, the companies, the manufacturers, whatever small they're doing, need financing, financial services, they need banking, they need credit lines. So we saw the central bank last year asking you banks to give some moratorium to those in the businesses. So what are you learning on the streets so far this year from your clientele at First Bank and others about how they are adjusting, if they will want more moratorium, are they feeling more comfortable and confident in the business environment moving forward?
Thank you. Yes, so the CBN has been gracious, just like the rest of the central banks and federal reserves across the world, for the ones that are within their purview, the intervention fund. You had the initial forbearance for 12 months. This was extended to by another 12 months till March of 2022. That is magnanimous. But despite, it's not how much of the intervention fund can a typical manufacturer take. 10 billion per segment, 10 billion per sector. Compared to the total cost of operation, is significant because it reduces their cost of operation, but it is not sufficient to help them. If you now had all of the operating issues that I've mentioned to them, they will certainly need more if it's available, but definitely because the central bank is not a Father Christmas, and the banks are in the process, in the business of earning returns commensurate with the investment of shareholders, they would at some point price their product effectively. Otherwise, they wouldn't be in business. So the journey is tough, but for the discerning manufacturers, for the discerning companies who have a strong Africa, Nigeria focus, who are clear about their policies and principles, we know that there are cycles in business. This is one cycle. There is always another day. So right now it might be tough, but some people are weathering the storm, and you see that across all of the segments. For manufacturing, of the 13 sector, 11 grew. But look at the principal sector, the food and beverages, and the cement. Cement actually recorded a decline of above 65% from 11% level to about 6%. That is significant because it has a reverberating impact across different sectors, real estate, wood, paper and pulps, all of those. There are so many linkages across the sector.
Yes. So, and here you have you banks and financial services in the middle of it all. So you talk about, well, there are business bust cycles, make gains and losses. That takes me to the current third quarter and the rest of 2021. Give me a bit of, tell me something sweet about the future here that I can take away for third quarter, fourth quarter of the year, when people will begin to say, look, it's been a year so far. I want to take some profit. I want to look at the marketplace. What are you looking at on the terms in terms of Horizon? Because we're getting to the season in which manufacturers, SMEs and others will want to produce for the end of the school year, the end of the year festivities and what have you. So are they booking more credit from First Bank and others, by the way, and your colleagues, by the way, being very hopeful that consumer demand and consumer spending is getting a little bit better?
Thank you. So as we move into the festive season, you know, where we used to be the happiest people on earth. Despite all the challenges, I mean, we still live hopeful. So I don't see any curtailment of what people would have done across the year end. They might do it on another scale because of reduced purchasing power. That is okay. But in terms of what I see, I think for us to move to the next level, number one, we have to be mindful of the fact that decarbonization trend across the world means that the demand for fossil fuel is changing.
Okay.
Yeah, and then we also have to look at the overall cost of operation of a typical manufacturing. We have the after.
So are you hopeful? Dr.
I am absolutely hopeful. I'm
hopeful as well. Let's take that to the bank, by the way. Thank you, Dr. Bunmi Bajomo, Group Head, Corporate Banking and Manufacturing at First Bank of Nigeria. Thank you for your time this evening, and see you next time.